The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Markets rally as investors fade the military risk. Live from Studio 2 here at Bloomberg headquarters in New York. I'm Romaine Bostick.
And I'm Alex Steele. We're kicking you off to the closing bell right here in the U.S. Romaine, I was off on Friday.
You were.
And if I blinked, it's like I missed the price action from Friday.
You missed absolutely nothing.
Which was unbelievable because you take a look now at the S&P, we're now up by almost 1%. We're off the highs of the session, but nonetheless, a rally and a turnaround from what we saw on Friday. Also selling in the back end. Now we're up by 5 basis points. And even oil, looking at Brent crude there, is down by 2%, Romaine.
Yeah, and that is where we start this holiday shortened week with markets really trying to shrug off what's been going on between Israel and Iran, seeing low chance that a regional skirmish escalates into a broader global conflict. Now, Friday's big dip in risk assets getting bought this Monday, and that bid to haven assets, that's getting sold, a repeat of a pattern that we've seen frequently as of late.
We don't think there will be much more major impacts. We think the impact on the oil price will also be a fade, as we have seen with prior geopolitical rising tensions. And the same goes basically for equity markets and the impact that we have seen there in terms of risk sentiment. So usually with these kind of events, it takes like 3 weeks until markets get back to their prior high.
Now, we should point out that today's rebound rally did briefly push the S&P intraday back above its recent cycle high and closer to that all-time record. A broad-based rally with the S&P equal weight keeping pace with its cap-weighted brother and the Russell 2000 outlapping them both with pretty big gains from names like EchoStar, Vera Bradley, and him and hers. That's on the small cap side. Estee Lauder, AMD, and Coty among the more notable of the larger cap movers. Now, this, of course, does not necessarily mean that the market is in the clear. We have a new round of missile launches going on earlier today between Iran and Israel, and that has kept the rates that shippers pay for oil tankers elevated, putting inflation risk back in the spotlight ahead of a big retail sales report from the government due tomorrow and a big Fed press conference on tap for Wednesday.
Lots of uncertainty, and yet we see a 1% move within the S&P. This is a great chart that shows that what stocks do after a down day. And what we've seen in the last, 5 years or so is that you actually see an increase following a big down day. So you're looking at a quick V-shaped recovery in stocks that followed April's sell-off, and we're seeing it again today. The question then becomes, is this the right kind of move? Are there buyers on the sidelines that want to buy a dip, or do you really want to buy at sort of near record highs with valuation again increasing when we continue to have these macroeconomics and geopolitical risks?
Let's bring Tom Tzitzouris into this conversation, Managing Director and Head of Fixed Income Research with Strategas Securities, a Baird company, as we kick you off to the close. And Tom, we've been here before with these Middle East skirmishes. We've seen the market reaction. Any parallels to what we're seeing play out over this Friday and this Monday from what we saw maybe in years past?
Yeah, and so the most obvious parallel would be the Iraq invasion of Kuwait. August 1990, you saw oil prices spike, but you also saw long-term interest rates increase, and the dollar actually wobbled a little bit lower, particularly versus the yen. And so that is kind of the playbook you're seeing happening right now. And I think what's happening, though, also is you're going to start to see more of this narrative in the media. Well, because that's what's happening right now, the dollar has lost its safe haven status. Treasuries are no longer the safe haven. And that's not really the case. I think what we saw over the prior 20 years is probably not the norm, where there was no alternative. If something went wrong in the global economy, even if it started in the U.S., the dollar rallied and treasuries rallied. Now there are alternatives. And so what you're seeing is you're seeing those alternatives rally first, and you're seeing treasury yields actually continue what is otherwise a seasonal weak spot for the treasury market because we're entering quarter end, and we're also going to be raising the debt ceiling soon. So those are the narratives that are triggering the yield curve to steepen. It's not really what's going on in the Middle East, although what's happening in the Middle East is amplifying the curve steepening.
When you talk about amplifying that curve steepening, we're actually heading in, of course, into a Fed meeting in a couple of days, or at least a Fed press conference, we should say, no real change in rates. But obviously, they're going to have to address a lot of these issues, what's going on with trade and whether that's feeding into inflation. And now, of course, what's happening in the Middle East. Yeah,
well, Jerome Powell was going to have to do his best Alan Greenspan impersonation here, because in 1990, Greenspan made a fatal mistake by watching those interest rates rise as oil prices spiked and they slowed temporarily the pace of rate cuts, very similar to what we saw today. Now, that proved to be essentially a death sentence for the U.S. economy, particularly the Northeast, which was very dependent on home heating oil, and the housing market was very dependent on those lower interest rates. And so you saw a weakening in the northeastern portion of the U.S. economy, bordering on a depression in parts of New England. Now, Jerome Powell faces a little bit different situation today, but nonetheless, the question is going to be, is this rise in oil and is the uncertainty triggered by the conflict in the Middle East going to be demand destroying? If it is, then the time that they spend holding on interest rates should be short.
That's amazing, though. It's just in terms of demand destruction, you're not going to get that at 72. Like over 100, sure, but I mean, the fact that we're not even close is kind of incredible. In terms of what is a safe haven, is the Treasury market a safe haven asset?
Absolutely.
And where on the curve is it still a safe haven asset? Well,
that's going to depend on what the risks are and what's triggering it. If it's an inflationary shock, clearly 10-year treasuries, 30-year treasuries are not going to be the safe haven that 2s or 3s are going to be. If it's more of a long-term demand-destroying shock, then 10s are the place to be, or even further out the curve, because you want duration. The best way to think about it is, let's say you have an equity portfolio where you want to balance the downside risk. The longer the duration you have, the better chance you have of balancing that downside risk, especially if there's a demand-destroying event that's going to trigger a downturn in equity earnings.
So, similar question. Is the dollar still a safe haven, or can it play a safe haven role in your portfolio?
It can, but it probably plays that safe haven role with a lag. First order is you see a flight back to, we'll call it domestic markets. And that's why the Japanese yen is going to rally, because there's a flight back to Japan. Eventually, if the market believes that the demand destruction is going to be prolonged, the only place that they can really go is treasuries in the U.S. dollar. But that has to be the second order flow.
I do wonder how the budget process folds into all of this. And I know there's a lot of moving parts into this. At least right now, it looks like that budget bill is stalled in the Senate. But if, at least as it's written now, it were actually to become law, how does that feed in to the rate picture? And is that sort of an immediate reaction, or is that sort of something that sort of trickles out over time?
Well, I think the key thing that's going to determine how this bill affects the Treasury market is going to be really how much tariff revenue is raised, and how does that affect the timing of the debt ceiling raise. Now, almost certainly, irrespective of the tariff revenue, we're still going to probably raise the debt ceiling in early August, but the tariff revenue will help to determine when coupon auctions are going to increase. Now, between now and then, let's say that coupon auction increase comes in the fourth quarter. Between now and then, there's going to be a lot of headlines about this bill blowing out the deficit. But when you eventually start to get the data and you start to look at the deficit numbers, you're actually going to find that deficit shrinking in calendar 2025. And tariff revenue is a big reason for that.
Is that why we also haven't seen any real sort of sloppy auctions, despite all of the hand-wringing about how this was just going to kill the auction process? Most of them have been pretty well received.
Yeah, I would say I wouldn't say they've been well received. They've been smooth. So you've gotten the deals off, you've gotten the auctions off, but there's been a tail most of the time. Now, with that said, 20-year auction today wasn't really a tail, and the bid to cover was higher. So we've seen, fits and starts here, and I think the fact of the matter is professional investors know that the deficit numbers are actually going to be shrinking in calendar 2025, and the tariff revenue is going to be enormous in this calendar year.
And that's not going to hurt growth.
Well, demand destruction would be good for the Treasury market, at least in the sense of flatter curve. So it very well could hurt growth, but that would be positive for at least, long bond investors.
All right, Tom, always great stuff here. Tom Tzitzouris, he's the managing director and head of fixed income research over at Strategas Securities, a Baird company, kicking us off to the close here on this Monday afternoon with a deeper dive up ahead into what's been rattling the oil markets as tanker owners pause offerings for Middle Eastern routes, given the rising tensions in the region. A discussion with Amrita Sen over at Energy Aspects.
Plus, a discussion on if and when those tensions between Iran and Israel can be diffused quickly with a man who knows the region very well. Ryan Crocker is former ambassador to countries like Afghanistan and Iraq. He's going to join us later on in the show.
And, of course, all of this happening on Fed Week, a breakdown of what to expect out of the Fed, a breakdown of what to expect out of some of the big economic data points, including retail sales. Dana Peterson, chief economist at the Conference Board, joining us a little bit later. This is The Close on Bloomberg. All right, let's get a view from the sell side with our top calls, big movers on the back of analyst recommendations. And we start off today with Cisco. Deutsche Bank upgrading to buy from hold. The analyst seeing increased volatility towards durable mid-single-digit growth in upcoming years for Cisco, thanks largely to tailwinds from AI. Those shares up about 2% here on the day. Next up, Celsius Holdings, TD Cowen upgrading the energy drink company to buy, an increase in the price target to 55 from 37, with the firm saying Celsius's management has course corrected on execution, and that should curb a decline in sales growth, citing momentum through innovation, nationwide expansion, and marketing efforts. Those shares having their best day going back to April 9th. And finally, AMD. Piper Sandler lifting its price target to 140 from 125, maintaining an overweight rating. The analyst says products unveiled at the company's accelerating AI event last week, that was a positive sign, and he expects a snapback for the GPU business in the fourth quarter. As a result, those shares up 9%, also having their best day since early April, and those are some of our top calls. We also want to keep an eye on Lennar. The share is fractionally higher as we move towards their earnings release after the bell tonight. The home builder expected to post revenue of about $8.26 billion and EPS of about $1.95 a share. Jay McCanless joins us right now, Senior Vice President of Equity Research at Wedbush Securities. He's got a neutral rating on the stock. And for Lennar, it's sometimes about sales, it's sometimes about the backlog, it's sometimes about mortgage rates. What's most important this quarter, Jay?
Yep. And thanks for having me on. We think the gross margin is going to be the most important because entry-level payment-focused builders like Lennar have been using gross margin dollars to pay down mortgage rates. And we're expecting a gross margin at 18% on the nose. The street's a little higher than us, but I think anything below that, anything below consensus may be more bad news for some of these payment-focused entry-level builders. We've generally been neutral to negative on this subset of the group for most of the year.
I'm curious, when it comes to margins, has the issue been pricing? I assume, given that mortgage rates are still in that high 6 to maybe 7 range, depending on your credit report, is Lennar and these other home builders, are they having to offer significant discounts to get people in the door?
Yeah, they are. Last quarter, Lennar said that their incentives, I believe, are roughly 12 to 13% versus normally being 5% of the home's average price. And we talked about it in our preview. You look at the mortgage rate volatility in the front half of April, and then just the fact that mortgage rates really haven't come down since then. And Lennar has been pushing a volume over margin strategy for the better part of 3 years now. And we think those things combined with the high mortgage rates are going to continue to weigh on profitability.
That's what's so funny about the home builders. It's like there's a chronic undersupply in the market, which means they need to build more, but then their margins aren't great because rates are still so high. They're like stuck between this rock and a hard place.
Yep, I agree. And what we've seen from Lennar and some of the other builders is they've dialed back on their housing starts because we think, and we've talked about, that there's maybe a few too many what we call speculative homes, or homes that are started without a sales contract. We think there may be too many specs, especially in the entry-level payment-sensitive buyer category. If they can start to wind down some of those inventories, potentially they'll be back in a place where they can start raising prices again. But we don't think we're there yet. We feel like, especially for the entry-level builders like Lennar, they're still going to have to be offering some pretty aggressive incentives and buy downs to drive volume.
So the stock is about $10 up from its 52-week low that it hit back in April. What's the downside potential for the stock, or do you think it just treads water?
Probably treads water to maybe revisiting the lows would be my guess. If we're right and earnings come in a little bit above, but gross margin comes in weaker, it wouldn't surprise me if the stock sold off some, because I think the other big problem, and we've heard this from the builders that reported during May, is that consumer confidence, especially for a very large ticket purchase like a home, seems to be under pressure right now. No surprise with all the headlines out there. But that's one of the things that builders have really talked about, is that in some cases rates are similar to where they were last year, but the confidence level, at least for some buyers, just hasn't come back like the builders thought it would. So I think that's another thing we're going to listen for on their call tomorrow, is how's the consumer feeling? Are they getting more active, et cetera?
Just real quickly, Jay, I mean, what is your general outlook for mortgage rates right now? And obviously, I guess that would feed into more of a question about where do you just see broader rates going with regards to the Fed and Treasuries?
Yep. So we came into this year with a call that mortgage rates probably move lower. I don't see anything to move us off of that. But the thing I would say also is that when we saw the Fed cut rates in back half of 24, mortgage rates actually went up, not down. So would love to see from the customer affordability standpoint, lower rates would certainly help there. But we're not betting on a Fed rate cut to move mortgage rates lower. We feel like over the rest of the year, there's probably more reasons that they should be moving lower than going higher.
All right, Jay, thanks a lot. Really appreciate it. Jay McCanless, SVP of Equity Research over at Wedbush Securities. Thank you very much. Looking for those earnings around 4:30 today after the closing bell. All right, coming up, oil prices sliding as investors signal the Middle East conflict may be contained. Energy Aspects founder Amrita Sen joins us with what to expect as critical supply-demand choke points still hang in the balance. We'll be right back. This is Bloomberg. All right, we're watching oil today. WTI is down over 2%. The Brent is down now by 2%. Iran reportedly willing to come back to the table on nuclear talks, wanting to de-escalate with the situation with Israel. 8 key choke points for energy market flows still at risk. How much of that geopolitical risk premium should continue to be priced in? Want to bring in Amrita Sen, the founder and director of research at Energy Aspects. 72 Brent. What should it be trading at, knowing the headlines that we know?
I actually think, given the fact that we haven't lost any supplies, the market is probably, fairly priced, probably a couple of dollars higher would also be fairly justified. Where I do worry about this market is that it's probably become a bit too complacent that there won't be any supply risks now or supply outages. We're not saying that's definitely going to happen, but we did see some outages, right? We saw Israel take out, a platform in South Pars 14 in Iran. That's definitely led to some losses in condensate and LPG. Gas production's also been affected. So it's not nothing. And I do wonder if the market's just completely dismissing the possibility that, there will be any supply outages whatsoever. You've seen that with the volatility today.
Yeah, and exactly, falling down from where it was on Friday. So putting the Strait of Hormuz aside, if we do get some strikes and there are outages in the oil and gas market, can the Saudis make up for that? Can the U.S. make up for that? Who makes up for that?
Great question. I mean, look, OPEC Plus is increasing production already at an accelerated pace. They do have spare capacity. Again, that does mean if there's a genuine outage over millions of barrels per day, there is spare in the market. But I would also caution that I think within OPEC and Middle East and OPEC, there will be, I don't think anybody's going to jump in order to fill that gap because nobody wants this situation to escalate. Everything that's going to be done by other countries in the region is going to be try to de-escalate this, right? So nobody wants to be seen to be taking advantage of a situation. But of course, if there is a genuine outage, OPEC Plus, it is adding barrels, and I think they will continue to do so to mitigate any of those risks.
I'm curious as to what the situation was like for the oil market prior to this. And I know, at least certainly here on the U.S. side, looking at the CFTC data, you definitely had a market that basically saw oil prices continuing to drift lower, or at least to stay low where they had been. What were the potential upside catalysts, Xing out, of course, the military conflict right now between Iran and Israel?
I'm glad you asked that question, because last month, literally just about a month ago, we put out a piece that was called The Pain Trade. And this was exactly something we were highlighting, that the market had continued to go short and probably too early. Our balances are calling for a build in Q4 in 2026. But right here, right now, inventories are very tight. China's buying for its SPR, and OPEC Plus, even though production's increasing, exports haven't because Middle Eastern summer burn is high and demand is high. As a result of that, we're not seeing a market that is loose at the front. And our point was that you might actually get these shorts having to cover before the market actually, weakens in terms of balances. And that's exactly what was playing out. And of course, the geopolitics has made it worse.
With regards, though, to some of the disruptions that we had because of, obviously, the sanctions that were already in place in Iran, obviously the issues going on with Ukraine and Russia, which it also had created some potentially, I guess, upward price pressures here. How much is that adding to the concern?
I don't think any of the Russia concerns are in the price because generally speaking, President Trump has been very reluctant to put any sanctions on Russia, even though, the wider kind of team or the Europeans are kind of asking him to do so. So that's really not in the price. I think what we've seen in the last couple of sessions has been the Middle Eastern conflict. I think your question is almost suggests, and I would agree with that, like if there were to be sanctions on Russia, the price could go significantly higher because even if there are workarounds, there will always be workarounds. You could easily get 2 to 3 million barrels per day of initial disruptions, at least.
Mm-hmm. Right, which is just more complicated when you don't have, say, Venezuela making up oil, for example,
exactly.
As well. If I'm a producer right now, and I'm an oil producer, am I hedging these levels? And does that make me sort of more immune then to if we do go into the 40s or the 50s like President Trump has made clear he wants?
Yeah, I absolutely think that one of the reasons why we've seen this short covering, the catalyst has been producer hedging. That was another thing we'd warned that, we are going to start seeing producers hedge because, again, if the outlook isn't rosy, they will use any rally. And the last couple of days, our quant team are pointing out this is one of the biggest increases you've seen in hedging, on a kind of day-to-day basis. And that, again, means that, if they're hedging the 2026 part of the curve, the curve's flattening, and anybody who has been short the December 25, December 26 contract, which we call it deck red deck, they're all getting stopped out. It does mean the producers have some protection for next year, especially like you said, if prices do go into the 50s next year with the bills. But at the same time, the flip side, of course, is that we don't get the bills because, just generally due to sanctions or whatever reasons that fundamentals end up being stronger than expected, then, of course, they will be underwater. But as of right now, all our balances do point to oversupply for next year. So the producer hedging would be prudent.
All right, Amrita, I have to leave it there. Amrita Sen is the founder and director of research over at Energy Aspects. All right, coming up in just a bit here, we are going to take a closer look at exactly what is transpiring over the skies of Iran and Israel. We had some developments coming up just a few minutes ago. We're going to talk to Ryan Crocker. He's a former ambassador to Afghanistan, Iraq, Pakistan. We're going to get his thoughts on the situation, how it's been escalating, and more importantly, what diplomatic options might actually be on the table. This is The Close on Bloomberg. 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Alex Steele. Equity prices still higher, oil still weaker. Despite the headlines, we're not seeing any calm within the Middle East. President Trump saying that Iran does want to talk, but he says that Israel says the strikes will go on. Yeah, and this gets to this idea of just how much further they can take this without it actually turning into more of a global conflict rather than a regional skirmish. Netanyahu was speaking a little bit earlier on the television networks over there, saying he wants three main results: the elimination of Iran's nuclear program, the elimination of the production capacity of ballistic missiles, and the elimination of, in his words, the axis of terror. That does not necessarily sound like something, at least right now, that is diplomatically feasible. But you have to wonder if axis of terror, does that mean the satellite governments, or does it actually mean regime change within Iran? And then how you factor that in with the political risk. Joining us now to discuss is Ryan Crocker, a distinguished chair in diplomacy and security at RAND. He's also the former ambassador to several countries, including Afghanistan, Iraq, Pakistan, Syria, Kuwait, and Lebanon. Ambassador, thank you so much for joining us. The axis, does that mean a regime change, or do you take that to mean something else?
Well, Netanyahu has set the bar pretty darn high here. The elimination of Iran's nuclear weapons capability, they are a far stretch from that. The elimination of its capacity to produce ballistic missiles, and the elimination of the axis of terror, whatever that means. And it is not the first time, though, that Netanyahu has hinted at regime change. And I would say all three of those announced goals may be pretty darn hard to achieve through an air war.
So what do you think that translates into? Because regime change was all the discussion over the weekend, because if you do regime change, that's when things can get really out of hand. How do you then understand the way forward?
Well, again, Israel has demonstrated tactical intelligence and operational brilliance in its campaign. That doesn't translate into strategic victory. So I am not really sure what the long-range plan of Israel is in this, nor for that matter what the forward thinking of the United States is. Clearly, Israel is winning this air war. I would expect to see the capacity of Iran to launch missile strikes at Israel to diminish as Israel takes a greater toll. But that does not lead to an end state that I can see. Again, you're not going to introduce regime change from the air. That would be a matter for the Iranian people. There is no evident leadership or opposition movement that looks like it could take the field. So it could be a step into the great unknown. As you suggest, what we may see, if there is an internal collapse, is who knows who will take over, with what agenda and with what intent.
Well, that's what I'm curious about. I mean, we kind of know where Israel stands. We, to a certain extent, know where the U.S. stands. I am curious as to where you think Iran stands. And the U.S. has had a very complicated relationship with Iran over the years and decades. I mean, in some cases, we cooperate with each other. I know you were very instrumental shortly after 9/11 in working with the Iranians to hunt down the operatives from al-Qaeda that attacked our nation. But of course, when we talk about regime change, it's not necessarily just the folks at the top, Ryan. I am curious about just regular people in Iran, and sort of what they can facilitate should we see some degree of collapse of that government.
Well, it's a great question. I'm not at all sure we will see that collapse. Again, the devastation that Israel has wrought on Iran is significant. Not just the military strikes, but the decapitation of its military leadership in Iran. But that does not mean that the entire regime is likely to fall apart. If anything, I think these strikes are rallying support for Iran in its struggle with Israel. And I don't see any movement on the ground or any capacity for movement. Look, we've seen this before in 2009, the so-called Green Revolution that did not pan out, that led to harsher crackdowns internally. We saw the demonstrations over the murder of a young woman that eventually were stamped out. So police states are enormously effective at internal control until they're not. But from the outside, you cannot predict that, nor can you bring it about. So I am not sure what we'll see in Iran. And I would venture without a lot of trepidation that neither can Netanyahu or Donald Trump.
Israel, of course, has a big ally in the U.S. and has multiple allies with a lot of firepower. We have not heard, at least publicly so far, anyone really come to Iran's defense in this. Its militias appear to be silent, probably because of the damage that Israel had inflicted on them because of the conflicts coming after October 7th. We have not heard from any of the other Middle Eastern nations that would potentially be allies in this fight. Is Iran alone in this fight right now?
I think they very much are. Clearly, the Arab states want to stay out of this. And that would include countries that have had supporters of Iran in the past. In Iraq, we've heard Muqtada Sadr, the Shia movement leader, say that while he condemned totally the Israeli attacks on Iran, this is a war that Iraq should stay out of. Similarly, we've seen no signs of Hezbollah seeking to re-engage militarily from Lebanon. So I think that Iran is very much on its own here.
Based on that, Ambassador, is it possible that Israel could execute and be able to tamp down and just ruin Iran's nuclear program? Because we can all agree that an Iran without nuclear weapons is a good thing, right? Is there a way forward where Israel gets this right?
Look, it would be absolutely wonderful if there were a way to guarantee that Iran no longer had the capacity or the ability to develop nuclear weapons. But I don't see how you do that. Their most protected nuclear site, Fordo, deep underground, I don't think Israel has the capability to destroy that site from the air. That would take U.S. 30,000-pound bombs to do. And even if the physical infrastructure of Iran's nuclear industry is eliminated, the knowledge is there. Israel has killed a half dozen or so Iranian nuclear scientists, but the knowledge is there. So I'm not sure that I see a way forward to eliminate in any lasting or guaranteed manner Iran's ability or capacity to develop nuclear weapons.
All right. We really appreciate you taking time for us today, Ambassador. We're going to have to leave it there. And, of course, the developments continue. You can continue following everything that's going on over there on your Bloomberg terminal on Bloomberg.com and, of course, right here on Bloomberg Television. Our thanks there to Ryan Crocker, our former ambassador, U.S. ambassador to Afghanistan, Iraq, Pakistan, Syria, and now at the RAND Group. We'll be back in a moment. This is The Close on Bloomberg. All right, it's time now for our stock of the hour, and we're taking a closer look at shares of Roku. Right now, those shares jumping about 11% here on the day. Best day going back to early May here on a deal with Amazon to expand advertising on connected TVs. Analysts still trying to figure out the financial impact here, but quite a few of them are optimistic that this will give Roku a leg up in a competitive market. Chris Palmeri joins us right now from our Los Angeles bureau. He leads our media and entertainment coverage here at Bloomberg. All right, so just explain this to me. I'm a Roku user. I get ads. So the idea is that Amazon partners with Roku and they give me more ads?
Yeah, more ads. It's not an exclusive deal, but Amazon is a formidable seller of ads these days, not just it has Amazon Prime and Thursday Night Football and all that good stuff, but it owns Twitch. I mean, it sells ads through Alexa or Kindle, every which way you can imagine. So they've built up this business, and this is really a joining forces of two of the biggest gatekeepers of that streaming world. So that, whether you use Roku or whether you use Amazon Fire, it's a lot of people are getting their streaming TV through that.
Shouldn't they be competitors?
They are still, but they're also found a way to work together. Yeah, and so there's lots of other people. We could have a connected TV with Samsung. You could have Apple. There's lots of other ways you can connect, but those are two biggies.
This gets to the idea, too. I mean, and I don't know, I guess we don't really do antitrust anymore, but it gets to the question here of the control that they have. But I'm also curious, Chris, I mean, as somebody who covers entertainment and media, in the eye of how we're sort of being distributed our content, is this pretty much just kind of a duopoly, more or less? I mean, it's Roku, Amazon, I guess if you believe of Alex, it's also Apple TV to a certain extent as well.
Yeah, well, there's, Roku is the pioneer in this, but there's nothing certain, and it's, they've tried to get in the TV business directly, as has Apple, because, other folks, electronics companies are having their own smart TVs that are coming out. So it's been a very competitive market. Nothing is a sure thing. And so I can remember TiVo was my way of connecting not too long ago. And so Roku, has to keep up, and streaming ads right now are really where everyone's focused on. This is the big growth area. The market for how many more Netflix subscribers is tough. So everyone's trying to sell ads. That's the growth.
Right. So this is the confusing part for me, that like the growth in ads is on streaming, but the money to be made from ads is still on linear.
changing very rapidly. Linear is declining, and streaming is growing much more quickly. So it is definitely it is a streaming world right now.
Just a quick correction. I said TiVo still exists according to their website here in the
Yeah,
U.S. They are strong. My apologies.
Good correction.
Not as big as they
I had
used
just
to be.
not heard of them for a while. So there you go.
Thank you
But I
very
used to be a
much.
TiVo customer. There you go.
All right, Chris, thanks a
Not
lot. We
anymore.
really appreciate it.
Thank you.
Chris Palmeri joining us. I said linear the other day in a conversation with my mother and my husband. They're like, that's not a real word. And I was like, that's a word? Yeah. And they were like, what's linear? And they made fun of me for it, and I got really upset.
Wow.
It's like it's streaming versus linear, and I talked to them about ad pricing. And
Yeah, but I guess it's the idea, though. I mean, we talked about the competitive nature and like how we get this stuff. And I forgot about the connected TVs. You can, if you have Samsung or something like that, you can just plug right in. You don't need Fire Stick or you need a Roku or TiVo for that matter. So I don't know. I guess it's just kind of a hodgepodge world.
we have both. We have like smart TVs in both, but then we also have the add-ons, which now that you say that, I don't understand why we have that.
I don't either.
Okay, I think this is a conversation.
Times. You're a great consumer.
I am a good consumer.
Alive.
Thank you. All right, we're going to take it to the closing bell coming up next. 15 minutes away here. Shelby McFaddin, investment analyst with Motley Fool Asset Management, is joining us. We are fading a little bit here. The S&P is still up by just 0.9%, so off the highs of the session. Tech, though, continuing to outperform, up by a full 1.5 percentage point on this Monday. Very different picture than what we saw on Friday with that V-shaped recovery now for the S&P. This is Bloomberg.
Jerome Powell was going to have to do his best Alan Greenspan impersonation here because in 1990, Greenspan made a fatal mistake by watching those interest rates rise as oil prices spiked, and they slowed temporarily the pace of rate cuts, very similar to what we saw today. Now, that proved to be essentially a death sentence for the U.S. economy.
A look back at Greenspan, a look ahead to Jay Powell. Tom Tzitzouris over at Strategas kicked us off to the close about 50 minutes ago. A lot of questions right now about where this market goes this week, if anywhere.
Well, definitely fading a little bit, but we're still up 0.8%. But what's interesting, Romain, is what's leading it. It's definitely still tech. NVIDIA up almost a whopping 2%. We're now near a golden cross where the short-term moving averages goes above the longer-term moving averages, which can be a bullish breakout signal. And you wonder then if that's sort of the safety trade, if you will, at this point, those large cap, big tech companies.
I would just also point out, though, this is a pretty broad-based rally. I mean, the equal weight index on the S&P, which I know you like, that's basically keeping pace with the cap-weighted index, and then the Russell is your outperformer, at least relative to the S&P on the day. So you are seeing some of the more cyclical and economic names get in on the action too. A lot of cosmetics companies as well. Coty, Estee Lauder moving higher as well.
Which is also a little confusing. Like we're just ignoring now. Is there too much complacency?
All right, well, let's see what our next guest thinks about that as we move closer to the closing bells. With just about 8.5 minutes ago, Shelby McFaddin joins us right now, investment analyst with Motley Fool Asset Management. All right, Shelby, are we complacent?
Well, it's interesting seeing a couple headlines today about the there is no alternative trade, that TINA trade. We've been talking about that since probably 2022, 2023, and realizing that piling into some of those sort of cosmetics names, as you've mentioned, that might have higher shareholder returns, that might be solid yielders, they're pretty decent for the long term, right? And they're going to give you that sort of core option when you don't want to go ahead and pile up more of the portfolio into the concentrated large cap tech than is already there. So we've seen a lot of it already go into things like Costco, Walmart, some of those really dependable consumer discretionaries. But once you've sort of hit that cap on how much you want in that particular space, you end up having to spread it out a little bit more.
There does seem to be a defensive nature to this rally as we kind of hold at that 6,000 level. Everyone's looking for 61.44 to reclaim that record high. I wonder if we get anything out of the Fed. I know they're not going to move rates on Wednesday, but they are, I think, for the first time, going to have to meaningfully address some of the issues that have been swirling out there with regards to trade policy, whether that's going to be inflationary, and now potentially what's going on in the Middle East. Any sense? I mean, the market's pricing in cuts starting, I believe, in September. But any sense that we'll get some clarity out of the Fed on that?
I think in this meeting, I'm one to think they might still be a little bit murky, mainly because every single time they get an update on something they were waiting for the month before, there's a new complicating factor. So we were thinking, okay, maybe we'll get a little bit of update on trade policy. Well, now there's more conflict, right? And so I think they'll probably address it, but will they be giving us an idea that they've got a formula for going forward? I'm not so sure. And I think at this point, none of the data is so aggressive in any one direction that they necessarily have to step up right away.
So if I've been listening to you for years, I would have bought Walmart and Costco. And if I'm kind of maxed out on those positions, what do I do?
Maxed out on Walmart and Costco, you could, if you don't already own MasterCard, you could take a step there. They're a toll taker, right? So if the market sort of comes down all at once in a recessionary format, payments still have to be made, right? Another option that we've looked at to give us some exposure to the AI takeoff without being so directly attached to it is ServiceNow. They've got a great CEO, former leader over at SAP. The retention rate is incredible there, and they're really well positioned compared to some of their peers to take off from agentic AI. So that's an option where you're not directly playing semis, you're not directly playing just generative AI as a whole, but you're playing IT in a really grounded sector where there's mission critical software and high, switching costs.
Interesting. Go to MasterCard for a second. How do you choose which is the better pick between a MasterCard and Visa and Amex? Because you could say they all do the same thing.
I would say if we want to lump first together MasterCard and Visa versus Amex, the question there is no debit exposure versus debit exposure, and then also having the premium tilt to American Express. So it's almost like in a league of its own. Then there's also the concept between MasterCard and Visa of international versus U.S. exposure. So Visa is really going to have the hold on U.S. and especially U.S. debit versus MasterCard being a bit more credit and international exposure. So in this time, if you're someone who subscribes to the trade of Europe is about to spend, then MasterCard could be a much better play for you as opposed to the U.S. consumer potentially plateauing or declining a bit.
So on that consumer side, I also saw that you like UPS, which seemed odd because I know UPS was going through some issues the last couple of quarters.
UPS is interesting because, yes, they have that unionized labor. And a couple of years ago, we did see that, we thought they were going to come out a little bit higher on those negotiations. But I think those who have been in the game with unionized labor for long enough probably priced in what they were going to deal with, and they've paid a lot of those costs up front already. What hasn't changed is the quality of operations there. Earlier this year, they went ahead and got rid of the SurePost business with USPS. They said, that's not working for us. It's not serving our customers well. That's not going to help us win the quality business we want. They are choosing to slow down the volume with Amazon. They're saying, this is not profitable business for us. Someone else can take it. So when push comes to shove, it's going to be, in my view, the companies with the most profitable business, not the most amount of business.
I am curious. I want to just get your thoughts on AI. And you mentioned ServiceNow. And it's funny because I was having a conversation last week with somebody. This is like their new chief people officer, Jackie Kenney, but she kind of had this secondary title of kind of being ahead of AI workforce transformation, and which I think was kind of the first time we had an executive in a Fortune 500 company with such a title. And it gets to this idea of how so much of the AI trade has been about the outward facing stuff, how this is going to improve our lives or the lives over there. But a lot of companies are using AI to prove their own efficiencies. And I'm wondering if you anticipate that we could start to see that show up in wider margins, better profitability. Are we at that stage yet where the implementation internally of AI is going to have a material impact?
I'm not sure if we're at the tipping point of most of the market doing it, but we are definitely at the point where we know it will be impactful. Company Shopify, everyone's heard about it. The sort of founder and lead operator there has been pushing this for a long time. They've basically said, we're not just AI first for our customers, we're AI first for our company. And that's making a massive difference. To your point, why not go ahead and use these advantages for how we do work and for also keeping people just happier and more productive? So I do think in a time where you have to penny pinch, not just in the household, but in the boardroom, you've got no choice but to figure out how you could be more productive on a lower base.
All right, Shelby, always wonderful to have you. Shelby McFaddin, investment analyst with Motley Fool Asset Management, counting us down to the closing bells here on this Monday afternoon. We should point out, Alex, that coming into today, we've seen some weakness in healthcare stocks. There's been a lot of talk about that Senate tax bill. That tax bill that's working its way through the Senate. And now some headlines on that the Medicare pharmacy benefit manager limits that were in that bill coming out of the House, that apparently has been stripped as it's working its way through the Senate.
Yep, and you can see the PBMs moving higher on that off the highs, but nonetheless moving higher on that like a CVS. Two other things to look for: SALT. We're waiting for what the SALT deduction will or won't be in the Senate bill, and also what the IRA tax credits will be in terms of very particular solar, hydrogen, nuclear, and battery storage as well. And we should point out this is a holiday shortened week, at least for financial markets, with the Juneteenth holiday, and of course the Senate trying to get things done before they go away for their prolonged summer vacation. A full breakdown of all of today's market action starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now we are 2 minutes away from the end of the trading day. Romaine Bostick here with Alex Steele, taking you through to that closing bell. with a global simulcast. It starts now. Scarlett Fu in the TV studio, Carol Masser and Tim Stenevec, they're in the radio booth as we welcome our audiences across all of our Bloomberg platforms, including our partnership with YouTube. A bit of a reversal, Carol Masser, from what we saw on Friday with a big sell-off, and today it's a big buy the dip.
I know, and I'm trying to figure out like how much has really changed. But having said that, I kind of just keep digging down. There's a lot of gainers in today's session. Semiconductors in particular, guys, up almost 3%. So really some outperformance there today.
I guess the optimism about perhaps Iran wants to talk to find some resolution to this got people more optimistic, Scarlett, but still it seems surprising to me that in an environment such as this, where we are seeing these two powers go against each other, the skirmish in the Middle East, that there is some buying that we're seeing today.
Yeah, it seems the path of least resistance for equities is to continue to go up, whereas the path of least resistance for bonds is for yields to go up. I mean, we've seen this equity market turn around, but yields continue to be higher for a second day.
Yeah, and JP Market Intelligence actually, though, changing their call today, saying that they're now tactically going from tactically bullish to cautious because of sort of the moving away from a buy the dip moment, perhaps. Some saying, look, we didn't have enough of a sell-off to have a really big buy the dip moment.
And that gets to the question is whether we do need to sort of retest back down to some correction levels before you get that reset higher. It'll be interesting to see how those analysts, strategists, expectations, their price targets for the full year and for the 12 months, whether that starts to creep back up given some of the tamp down in the trade rhetoric. We get the closing bells here on this Monday afternoon. Green across the screen with the Dow Jones Industrial Average up more than 300 points or about 0.8%. The S&P 500, a 50-plus point gain on the day. It opened above 6,000, and it's going to close there up about 0.9%. The NASDAQ indices each up about 1.5%, while the Russell 2000 closing out the day higher by 1.1%.
All right, to the S&P 500, back I go. Most names in the index higher today, Scarlett. 364 names gaining ground, 139 to the downside.
All right, let's take a look at the IMAP. The 11 sectors in the S&P 500, 7 sectors are in the green, including the largest ones, communication services, infotech, and consumer discretionary. That reflects all the Mag 7 sectors, and in fact, all 7 of the Mag 7 names are gaining ground as well. So you have 4 sectors gaining at least 1%. The laggards on the day are utilities, healthcare, and energy, each down anywhere from 0.3% to 0.5%.
All right, guys, let's get to some of the individual gainers in today's session. There was a lot to choose from. AMD, that's your number one gainer in the NASDAQ 100, number 2 gainer in the S&P 500. Stock up 8.8%. You really did see a broad rally in the semiconductor space, but Piper Sandler said products unveiled last week by AMD were positive and expects a snapback for the GPU business in the company's fourth quarter. You also had BNP Paribas come out, an analyst there saying in a call on AMD held with Friday with analysts that they sent a reassuring message heading into results next month with AI traction increasing for AMD's Instinct GPUs. So some really a lot of optimism there when it comes to AMD. Estee Lauder, next name for me, number one gainer in the S&P 500, and that stock up just shy of 11%, so pretty much closing at its best levels of the day. China retail sales grew 6.4% last month. That's the fastest pace since December of 2023 and exceeded all estimates. So those names like an Estee Lauder that have a big Chinese exposure really gaining today. I should point out Nike, Starbucks, Canada Goose also gaining in today's session. We also should point out that yesterday some sad news from the Estee Lauder community. That is that Leonard Lauder, which was one of the sons of Estee Lauder, the founder of the company, passing away. A long time, obviously, in terms of running and strategy for that company in particular. And then I just want to mention WBD. I hope I gave the right ticker. Warner Brothers Discovery. Did I mess up?
You messed up.
I messed up.
Hey, but it's still a gainer.
I realized it. Yeah. But that's not where I want to go. But anyway, WBD, Warner Brothers Discovery, that is your number 2 gainer, I believe, in the S&P 500. Forgive me, Finley, I messed up. Up 7.3%, Warner Brothers Discovery, and that's after the company won enough support from creditors to overhaul its debt as part of a plan to split the entertainment giant into 2 separate companies. I'm so sorry.
Can I just add an honorable mention? Because when I ran the most function, the number 1 gainer across all of the tapes was some tiny biotech company, Regencell, which I might be mispronouncing. It was basically a penny stock about a month ago. It's now trading at $59 a share. Wow. It had a big stock split today, 38 for 1. It rallied as much as 400% on the day. This was a stock that had a market cap of a few $100 million just a few weeks ago, and now has a market cap of almost $30 billion today.
What's the short position on that puppy?
I haven't looked, but I'm sure it must be
now.
high. Yeah.
Not now.
Wow. Okay, let's get
Which
to
point out
some
it has no
decliners.
profits, no revenue, or anything else. Too.
Yeah.
So, yeah.
That's a good honorable mention.
Good honorable mention.
Thank you.
Romaine always says the good honorable
I know.
mentions. Hey, let's start with Lockheed
Well,
Martin
not all the
in terms of decliners today, down 4%. This news just breaking after, and it's not the reason why it's lower. Lockheed Martin did name a new chief technology officer. That just crossing moments ago. We did see U.S. defense stocks erase earlier session gains that we saw today. This after we heard from the president, who said Iran wants to talk about de-escalating the conflict with Israel. Northrop Grumman and L3 Harris Technologies also fell in terms of defense stocks today. Lockheed Martin, though, the worst performer on a percentage basis in the S&P 500. Also moving lower today, energy names among the worst performing sectors in the S&P 500. Diamondback Energy down 2.5%. Energy companies also falling, with oil prices on expectations there would be less disruption to oil supplies. Diamondback Energy, the worst performing energy name in the S&P 500. And then a biotech name that fell a lot today, Sarepta Therapeutics, down 42%. The company's gene therapy for a rare muscle disorder has been linked to the death of a 15-year-old boy. It's the second patient to die of acute liver failure while being treated with the therapy. Shares fell today by 42%.
Oof, well, on that note, thanks, Tim. I guess I'll go to yields. So there was a sell-off in the bond market pretty much all across the curve. The back end getting hit the hardest with the yields up by about 6 to 5 basis points. 20-year auction went off without a hitch. But just so interesting when you have these kind of headlines and you're still seeing selling in the treasury market. Same with the dollar. Just raises the question, at least for me, like where do bonds and the dollar fit as a safe haven asset in your portfolio? I know we're all taking a breath after Friday, but there are still so many risks out there. And yes, they're hard to price, but at least we know that they come from Iran and Israel right now. And yet still we're not necessarily 100% pricing that in at all.
All right, guys, we're going to get to, obviously, we have a Fed meeting this week. They'll be looking at the labor market. We're looking at the labor market on this Monday because if you are a recent college grad, it's not so great. Pretty bad, in fact. Recent college and high school graduates are facing an unemployment crisis. This is coming from the Wall Street Journal today. Overall national unemployment rate, around 4%. New college grads are looking for work. We're talking about 6.6% unemployment rate over the past 12 months ending in May. And that is about the highest level in a decade, excluding what we saw during the pandemic employment spike. So not so great.
As Carol mentioned from the Wall Street Journal, this data from the Labor Department, though, people who are between the ages of 20 and 24 who are looking for work, who have at least a bachelor's degree, young graduates face a higher unemployment rate than their counterparts who've been in the workforce longer, according to the journal. But the gap now is growing wider between adult workers and the young. So those ages 35 to 44 with bachelor's degrees had a 2.2% unemployment rate over the past 12 months. That was up from 1.8% over the prior period.
And legit question on like how much is distorted too about all the layoffs for Doge and government workers, right? Like there's a lot of individuals recycled into the market now. So how does that wind up sort of clouding and messing up the picture?
Yeah, and these young, fresh graduates are not even counted in the unemployment numbers just yet. So you could watch that unemployment rate that the Fed focuses on so carefully tick higher later on this year. Another story we're following is Meta Platforms finally monetizing its WhatsApp unit. It's going to start showing ads in the Updates tab of WhatsApp. I've never used the Updates tab, so this would allow users who don't want to see ads to just continue using WhatsApp for messaging and calling without seeing them. What's the point then? Who's actually going to go in and look for that Updates
There's like
tab?
channels and stuff
Wait,
on the Updates tab.
This tab gets 1.5 billion visitors per day.
Well, why are they going there? I don't understand.
They're looking for updates.
No, but if you look on it, there's like channels, and you can subscribe and follow, and there's like,
and now
for
there's
some reason,
ads.
I have a lot of sports channels on my Updates tab.
They don't know you then.
They don't know me at all. Yeah, they're clearly not tracking me, so there's that.
That's not good targeted advertising for Alex.
Remember when Meta bought WhatsApp back in 2014? I remember this because, Scarlett, I was subbing for you on surveillance because
my God.
you were off and everyone was like, what is this company? This was like 5 people worked there and it was like per head they were paying a ridiculous amount of money. Finally, they're going to monetize it.
Well, years later, all the bankers know what WhatsApp is, and so did the regulators.
I look at Meta. It was up almost 3% today, man. They're up almost 20% year to date. I feel like they are kind of firing on all cylinders. I mean, just figuring out ways to monetize kind of all of their platforms. So I guess investors like it. I don't like ads. I'm tired of it.
I want to get away from ads.
Me too. Me too. All right. That's a wrap. Our Monday's over. Yay, almost. That is a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. We call it the closing bell. Alex is heading out. Scarlett and Romaine continuing on the close. Be sure to stay with them or stay with Tim and I right here on Bloomberg Business Week Daily. We'll see you tomorrow, guys.
When we come back, we tilt our focus back to the economy, global and the U.S., and, of course, that big Fed meeting that kicks off tomorrow. We're going to break down all of those expectations with Dana Peterson, chief economist at the Conference Board. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostick. A bit of a rebound from what we saw on Friday, that big sell-off on concerns about the situation in the Middle East. A lot of dip buyers coming in today, shrugging off some of that conflict, basically an interpretation that maybe that stays a regional conflict, a regional skirmish, rather than something more broader and global. The S&P back at that 6,000 level, up about 0.9% on the day. Most of the other indices here in the U.S. posted gains of roughly about 1% or more. A big part of that, of course, was the drop that you did see in WTI crude, down about 2.4% here on the day. That helped to lift some of the, more sensitive stocks out there, including the Philadelphia Semiconductor. As a whole, Scarlett, up about 3% on the day, back to the highest level since late February.
Yeah, we'll keep an eye on that, certainly. A couple of the individual movers I'm focusing on today. Let's start with MGM Resorts, climbing 8%. That is the most in 5 weeks. The gaming company has an online gambling app called BetMGM that it shares with another company. Well, that company upgraded the full year profit forecast for BetMGM. So you're seeing a big spike up in that stock. Meanwhile, defense contractors, including Lockheed Martin and Northrop Grumman, declining here as fears eased that the Israel-Iran conflict will escalate into a broader regional war. So far, that does not seem to be playing out. So you're seeing some easing in those shares. We should mention as well that after the market closed, Lockheed Martin announced a new chief technology officer. Now, that brings us to our top story this hour, which is the conflict in the Middle East has become the latest wedge issue between President Trump and leaders from the Group of 7 industrialized nations at their annual gathering. Bloomberg has learned that Trump is refusing to back a proposed G7 statement urging Israel and Iran to de-escalate their latest conflict. The host, Mark Carney of Canada, has decided against even seeking a joint communique from the event. So it's clearly a sign of the divisions between the U.S. and the rest of the bloc. Instead, Trump appears to be prioritizing ongoing trade talks with the leaders, saying a deal between the U.S. and Canada is, quote, achievable in the coming weeks. Romaine?
All right. And of course, we will sort of keep an eye on those developments coming out of the G7, which does set the stage for a pivotal week ahead for central bankers alike. That's highlighted, of course, by a big decision by the Fed on Wednesday. No expectation for them to move rates, but a lot of questions certainly to be lobbed at Jay Powell about what the Fed might do next. Dana Peterson joins us right now, the chief economist over at the Conference Board. And Dana, like I said, no real expectation for a change in rates. But Jay Powell is going to be asked a lot about the state of the labor market and, more importantly, about where he sees inflation going on the back of those tariffs and now potentially on the back of a move higher in oil prices. What do you expect?
I expect no change in interest rates, but certainly greater caution from the Fed. They're going to release their SEP. I think for the most part, those forecasts will be largely unchanged, but they might tick down GDP a little bit and increase inflation slightly. And certainly if they do believe that tariffs are going to be very negative for the economy, we think that there will be greater signaling that there will only be 2 interest rate cuts this year.
This gets to a broader question, Dana, just really about what the health of the economy is. I know there's been so much speculation about the impact of tariffs on the economy, as well as other policies coming out of Washington. At least for right now, we have not seen that materialize in a significant or major way, I should say. Is the economy healthy right now, in your view, Dana? And more importantly, do you think it will stay that way for the rest of the year?
Fundamentally, the U.S. economy is fine. We are still at full employment. Even though you do have some layoffs on the margin, it's really difficult to pinpoint them to say, fiscal policy or even the tariffs yet. Also, inflation continues to slow. And yes, we did have some strange data in the first quarter with respect to GDP, but when you looked at domestic demand, it was fine. And so we think that the second quarter will also show some weird data as we see some evening out between inventories and imports. But for the most part, the economy is doing fine right now. But we do think that tariffs will start to raise prices in the third quarter and potentially slow down growth, especially among consumers.
You know, you mentioned weird data, and I wonder to what extent everyone just has to get accustomed to the idea that we're going to have 3.5 more years of weird data, because the way the president conducts policy is things come on, things are taken off, and things change repeatedly, and no one has any better visibility 6 months down the road than they did 3 months ago.
Yes, uncertainty is definitely the word here. We did see uncertainty affect the data in the first quarter, where many consumers pulled forward purchases and many businesses also stocked up. And we're going to see kind of the reverse of that in this quarter. And as long as you have policies that come out and then retract and then are something different, then you have to keep adjusting your forecast, or at least what you think will happen. Or you could just sit and wait and see, wait for things to settle. But it's just going to be very uncertain over the next few years.
We were talking about the labor market a little bit earlier, and I'm wondering what are the dynamics within the labor market that's most likely to change or turn on a dime. We talked a little bit earlier on about how there's a fresh crop of college graduates that can't seem to find jobs, and their numbers haven't really affected the unemployment rate, but at some point down the road later this year it will, and that is the number that the Fed is looking at most carefully, that unemployment rate.
Absolutely. So the unemployment rate has been creeping up a little bit. And that's mainly people who have lost jobs but are finding it difficult to find new positions. And again, I think that's because we're still at a roughly balanced labor market between supply and demand. So companies have what they need for the most part, and they're not looking to hire people. And certainly with the uncertainty regarding trade and tariffs and also fiscal policy, I think a lot of companies are just on hold. So you're going to see the unemployment rate just kind of gradually move up. As some industries do let people go. But certainly if we see those industries really being battered, then we could see the unemployment rate rise quite precipitously this year.
For right now, are consumers still spending, Dana? We get retail sales tomorrow, and I know there's a lot of distortions going on in that data because of some of the pull forward and hold offs, if you will. Are they still spending?
Well, certainly in April they did spend, not as much as they did in the previous quarter. And we think that the spending will probably still be kind of modest. But it's also the case that maybe consumers are thinking, well, tariffs are kind of off the table right now, so maybe I'll continue to kind of stock up and spend. But I think consumers do definitely have the income. They're working. Wage growth is strong. Income growth, real income growth is very strong. So even if consumers start pulling back, they do have the capacity to spend.
Dana, as we wrap up our conversation, the Fed begins its two-day meeting tomorrow. Despite Jay Powell's best efforts to not surprise anyone, what's the thing that most likely could surprise investors in the market?
I think if there's additional worry from the Fed about a stagflationary scenario where inflation starts rising very rapidly, meanwhile, the economy is slowing because consumers are holding back, businesses are on hold. And even if you have some spending cuts from, fiscal policy, that's going to be very awkward for the Fed. And I think that, certainly they'll be looking at all of these indicators to see what's next for them.
All right, awkward would be it. All right, thank you so much, Dana Peterson, Chief Economist at the Conference Board. Coming up, we've got the top three, where we focus on the top three movers and shakers at the center of the day's biggest stories, including a big change at a fashion house. This is The Close on Bloomberg. It's time now for the top three, where we name drop the people driving some of the day's most talked about stories. And first up is Luca De Meo. He is the CEO of Renault, but not for long, because the French luxury giant Kering has hired De Meo as chief executive to turn around its struggling brands, which include Gucci. De Meo will start taking over in the middle of September.
Yeah, I mean, this is he's got a great track record. It'll be interesting to see the kind of the transition, though, from sort of being kind of a corporate exec to a car making executive to now a fashion house. And I mean, let's face it, fashion is kind of its own sort of amalgamation of things and a little bit different, but clearly he has the executive chops. So it'll be interesting to see if he can do it. Speaking of executive chops, I'm keeping an eye on Hillary Super. She is a relatively new CEO of Victoria's Secret. She just took over last year, but she's been facing a lot of pressure from activist investors. First, BBRC took a stake and started advocating for change. And now an activist investor called Barrington Capital Group has a massive stake of only about 1% here. But it gets to this idea is that whether these investors are going to give her time to do. I think she just took over in September of last year, so we're not even at the 1 year mark here in her tenure for a company that, let's just say, had some issues in the past.
Absolutely. She's been building her leadership team, making Victoria's Secret brands more appealing to younger demographics. But this activist investor really wants Victoria's Secret to refocus on key categories like bras and also accelerate online and international growth. So basically do everything now.
Yeah, do everything now, which is unfair to her. And also, you know, she is a retail veteran. She worked at, she was executive at Anthropologie and Urban Outfitters.
Rihanna's a lingerie brand too.
Yeah, exactly. So I think that would give her a little bit more
breathing room.
Yeah, more breathing room to do what she needs to do.
All right, third on the docket is Shaq, the NBA Hall of Famer, agreeing to pay $1.8 million to settle claims that he promoted the now collapsed FTX crypto exchange. This settlement really raises questions about athletes and their future business dealings and endorsements.
Yeah, I'm actually really interested in this because they're saying this could have some huge ramifications for endorsers who in the past, of course, have been shielded by these types of settlements.
You think Tom Brady and Giselle will have to pay up as well?
I don't know. Is Shaq and Tom Brady, are they the same level? Sorry. All right. Anyway, another person that we're keeping an eye on is the relatively new CEO over at Red Lobster, Damola Adamolekun. We got a chance to catch up with him just about 1 year since the restaurant chain filed for bankruptcy. And since then, the seafood establishment has actually turned a quarter. And listen to what he had to say.
There needs to be a reason why people come to your restaurant besides just food. So the food needs to be great. That's a starting point. But in addition to that, it's about great service and hospitality. Make sure people feel well taken care of, right? And I say service is what you do. Hospitality is how you make people feel. So make sure they feel like family and feel like they're home when they're in your restaurants. And then two is the ambiance, right? So the lighting, the music, the decor, the color scheme. Make sure the restaurant feels and looks amazing. And people have a lot more fun, especially young diners, when they come to eat at your restaurants.
But there's been a lot of discussion, particularly about younger diners in this day and age, that are kind of in a rock and hard place. You kind of have the high end, kind of white tablecloth restaurants, and then you have these fast casual places. And it's raised a lot of questions as to sort of where a Red Lobster and other chains like yourself sort of fit in, not only just in terms of price, but also in terms of that experience. And I am curious if you're pushing up against a longer term trend. I don't want to say it's irreversible, but a longer-term trend that might be hard to push back on.
Well, so you make a great point, and the way you address that is, the higher-end places tend to be less approachable, and the fast casual places tend to have less in terms of guest experience, right? You're really coming for food and for speed of service. So our sweet spot is a great experience, right, which you can't get at the fast casual places, but more approachable than a high-end place might be, right? So it's an approachable. It's approachable high-end experience or approachable dining experience that you can still have fun with and not, you don't need to wear a suit to come to dinner, right? So that's kind of where we sit, and we're going to have to make sure that's communicated, and it's a great offering for people to kind of hit that sweet spot.
I got to ask you about the endless shrimp promotion that helped tip Red Lobster into bankruptcy. Is this something that customers remember and kind of clamor for and ask you about? How much do you acknowledge previous strategic errors versus just ignoring it completely?
Well, one thing to remember with Ultimate Endless Shrimp is that it was a very successful promotion for a long time. They debuted it in 2004, and it wasn't until Thai Union owned the company that it became the financial nightmare that it did become. And a lot of that is how it was executed, not just the promotion itself. It was executed very differently under Thai Union's ownership. So, we don't have any immediate plans to return it, but we're being thoughtful about what's worked in the past, how things were done in the past, and any future returns of any sort of promotion will be well thought out to make sure it has a positive impact for our business and not a negative one.
That was Damola Adamolekun, CEO of Red Lobster. I don't know about you. What was your favorite dish at Red Lobster?
I have to admit, I was not really a Red Lobster person growing up. I grew up in it was like vegetarian family. I had a rough childhood. I didn't actually have like a steak until I was probably 25 years old.
I'm learning all kinds of new things about romaine all the time. All right, we've got more coming up on the close. Keep it right here. Lars Barstad of Frontline joins us next. Welcome back to The Close here on Bloomberg Television. Geopolitics and trade are front and center at today's G7 summit in Canada. Leaders of some of the world's largest economies pushing to de-escalate the conflict in the Middle East, with President Trump calling for immediate talks between Israel and Iran. For more on what we're learning from day one, let's bring in Bloomberg's David Gura, who is on the ground in Banff, Alberta, Canada. David, give us the lay of the land here.
So we had a meeting this morning between Prime Minister Mark Carney and President Trump, and that took about 90 minutes. And for about 15 or 20 minutes of that, they came out and fielded questions from reporters. And it was kind of an extraordinary start to this summit because the president allowed that he thought it was a mistake to kick Russia out of the G7. It was then the G8, of course, kick them out of the G8, make it the G7 back in 2014, and blamed Prime Minister Justin Trudeau for doing that. It was actually Stephen Harper who was in the G7 at that point in time. But no matter, it was an extraordinary way to start this and was certainly off-keeping from kind of the scripted way that Mark Carney hoped all of this would unfold. So from there was a kind of meeting of all 7 nations in which they talked economic issues. And I should say, what you just mentioned, the crisis in the Middle East, along with tariffs, are the 2 issues that are not officially on the agenda here, but are looming large. There was some hope among many of the participants in this summit that they could all come together and issue a statement urging Israel and Iran to de-escalate that conflict. The U.S. decided it would not sign on to that. The president didn't want to sign on to that. So that's a disappointment for those other world leaders here who hope that there could be some element of a unified voice here on that issue, at least at a time when they're not going to pursue kind of joint communique on a wide range of issues that they have, as they have at the last 49 of these summits since the G7 was founded.
I mean, I saw a little bit earlier, David, when Carney and Trump were standing there prior to the meeting, and Trump was asked a few questions about this here. Did they articulate at all what any sort of response would be, particularly if we do start to see that continued run-up in oil prices?
He spoke the most about this as he was leaving Washington to come here, and he once again urged a diplomatic solution to this crisis. But of course, reaching that diplomatic solution when there is a roiling crisis and that crucible of crisis is extremely difficult. But it's what he reiterated again today, that that's the only way that they can kind of come to a resolution here. And he once again said he's not going to stand for Iran obtaining nuclear weapons. So I think it's, again, a disappointment to those other leaders here. It's also something that was going to be closely watched by all of them as they came here to see if they could get the U.S. on board. But right now there is no track for that to happen. I should say one other thing that the president mentioned as he was leaving Washington is maybe these 2 sides, Israel and Iran, need to sort of fight it out a little longer to make them realize that the only solution is for them to come to the table once again. But of course, there was that framework for nuclear conversations. They were supposed to take place. They were canceled. The meetings on Sunday. So it seems like it'd be increasingly difficult to get them back to the table.
All right, David Gura, our man out there in Canada, keeping an eye on what's going on with the G7. Meanwhile, we keep an eye on what's been going on in the Middle East. Of course, that big run-up that we saw in oil prices on Friday, pulling back just a touch here on this Monday, though we should point out that freight rates to ship oil from around the world, that still remains elevated from where they were just a few days ago. Let's get some perspective right now from the head of one of the world's largest oil tanker operators. Lars Barstad is the CEO of Frontline, and he joins us here in New York in Studio 2. Lars, great to see you here.
Well, thank you for having me.
You've probably already had to deal with a lot of disruptions and where things go safely, where things go cheaply or economically, I should say, because of the disruptions from previous wars that are still going on with Ukraine and Russia, the conflict in Gaza, not to mention just the overall disruption from what's been going on with trade and tariffs. How did what happened over the last few days between Israel and Iran change that, if at all?
Well, so far it hasn't really changed much, but of course it heightened the risk. We have 81 tankers sailing the oceans, and at any point in time, some of them will be in the Middle East. We've got more than 2,000 seafarers on these vessels, so this is obviously of grave concern to us. But so far, and knock on wood, shipping seemed to be untouched. But this is also one has to remember one of the most watched areas of the world right now.
Yeah.
So we're quite confident that we're sailing safe as it is right now, but this can develop.
As things develop, how quickly can you pivot? Either rerouting ships or rerouting pickups and drop-offs and things like that. Is there enough flexibility to do that?
Yeah, there is.
Yeah.
And we have kind of within the charter party, which is the contractual obligation to the owner of the cargo, there's a lot of points where you can kind of alter the course or basically refuse to go in.
I'm wondering if you have a geopolitical analyst or expert on staff. How do you game out different scenarios that could happen and strategize your response or how you want to be positioned?
Well, this is where shipping kind of comes together. All our ships are managed by different managers. They will collectively sit down with security analysts, professional companies that follow this. These companies are in direct contact with US Navy, UK Navy, and so forth. So we actually have like a daily call in the morning where we kind of assess the current situation. And then the navies will share any observations, any information they have, and so forth. So it feels kind of comfortable.
But you're kind of constantly monitoring and being very vigilant about things. What are your customers, the big oil companies, telling you about the situation? What kind of on-the-ground dispatches have they given you?
Well, actually not that much, to be quite honest. But, there are a little bit question marks right now because, I think one of the effects of the disruption that we're currently looking at is that, say if you're an Asian refiner, wouldn't you rather go for the West African barrel, the US barrel, the Brazilian barrel, rather than the Middle Eastern barrel? So this can kind of alter the trading patterns somewhat. But the charterers and ourselves are basically in the same situation. Safety is kind of the first.
I'm curious, in the past though, and you've been doing this for a long time, in the past, usually to a certain extent, energy production, energy shipping has sort of technically kind of been off limits, not necessarily by any sort of formal agreement, but it's always sort of been like, okay, these wars might be taking place, but the idea is that this trade still has to flow to some extent. I know there's always sort of rogue groups that might get involved, but generally the big state actors have usually found a way to keep things flowing. Is that true?
Absolutely.
Yeah.
And this is what makes kind of the Red Sea situation kind of unprecedented when that started to erupt with the Houthis attacking, well, almost random vessels. So, but we've always been exposed to piracy. We've also been exposed to security risks. But you're absolutely right. Normally, kind of commodities and in particular oil will be allowed to flow. It's kind of. Both Iranians have the interest of oil to flow, and so does, of course, all the other parties to this conflict.
When there are disruptions like this and prices go up, I would assume, at least for your business, that ends up being accretive, right? Is there some sort of knockdown effect, though, in terms of the risk that's baked into that you have to shoulder, that your company has to shoulder?
It's, basically what you're referring to is what we call war risk insurance. So that's not always totally covered by the charter party, depending on kind of how quickly things evolve. But in general, as I mentioned, we have the same interest as the owner of the cargo, and normally, kind of all costs will be covered in such a situation.
Something you've told our reporters is that tanker owners take their cue from insurers in determining the risks associated with the trade. But you also point out that it's too soon after the attacks for that calculation to have happened. So at what point does that begin happening?
It's basically a price discovery process. And of course, it involves freight as well. We're in the market to make money. So kind of both on Friday and today, the market, it's been kind of, to use an expression, Mexican standoff between charterers and owners to figure out what is the right price for accepting to commit to lift a Middle Eastern cargo right now.
How much do both sides rely on what's happened in the past to kind of set the template for what's going to happen in the future, even though this is all very unpredictable?
Yeah, no, there's several playbooks, and where kind of almost infinity is the limit to kind of how far this can run. But I think kind of the background music, if you can call it that, what's going on. We just saw today immediately the derivatives market around shipping kind of started to sell off the minute the Iranians signaled that they wanted to have discussions with Israel. But then, as we see Israel looking to continue their operation, suddenly it tightens up again. So it's a very fluid and efficient market that the prices is.
This is more of a broader holistic question just about kind of the state of the world. And the idea that for years, at least coming out of the post-World War II era, this idea of a more global economy, and which led to a certain degree of cooperation. There are obviously still tons of conflicts that had to be fought out and resolved over that period. But there was this sense of cohesion. That cohesion seems to be, at least in perception, missing right now. The two world's largest economies barely speak to each other. You have a lot of trading partners that are now looking for new trading partners because they feel like the old ones are unreliable. Does that pose a risk to you, or do you you and Frontline, do you still thrive no matter what the situation is? As long as something's being sold to somebody in another country, you're going to still be a player in that?
Well, ironically, kind of this global polarization, as you're referring to, actually creates ineffective trading lanes. So it's not particularly good for the environment because our ships do emit, but for us to travel longer distances is actually not the worst thing. But ever since kind of China joined the World Trade Organization back in 2000s, we've actually had an extremely effective global trading system around most commodities, and this is now kind of gradually dismantling. Which is, I think, more a worry to global growth rather than shipping specifically.
As we wrap up this conversation, what's the thing that keeps you up at night? What do you worry about the most right now?
It's basically having, a rocket into the side of a ship. So it's, we're carrying kind of a hazardous cargo, can be explosive, and we have the seafarers. So this is kind of what it doesn't really keep me up at night, but it's the call I don't want.
Yes, well said. All right, Lars Barstad, thank you so much for joining us, the CEO of Frontline, here with us in New York. All right, let's take a look at how markets closed on the day. We had a recovery, Romain, from what we had seen on Friday, the sell-off on Friday. Today, we're getting reports that Iran is willing to de-escalate hostilities with Israel, as Lars Barstad was just talking about. So that eased some concern. You see the VIX coming off as well. It's now at 19. Remember, last week it got to a high of 22.
Yeah, I mean, I created this whole index kind of all the stocks that were moving off of the violence that we saw on Friday here, and it's interesting to see them all flipping. So basically, anything that was in the red on Friday was in the green today, and vice versa. So a lot of the shipping stocks that had rallied last week, of course, taking a little bit of a leg
defense
down.
Companies.
Same thing with oil prices, defense contractors, et cetera. But even a lot of the trade companies, companies that have a huge exposure to trade, so that, like automakers, for example, and things like that. You also saw that reversal. So maybe the market is, at least for right now, a little bit more comfortable.
Not much of a reversal in yields, though. Yields continuing to move higher. The 10-year yield up about 5 basis points at 4.44%.
Yeah, and that actually might be more a function of still concerns about inflation and, of course, what the Fed might do going forward. All right, a lot more coming up here on the show. Stick around. We're going to take a look back in history and a closer look at Amazon and its biggest acquisition ever, that $14 billion deal to buy Whole Foods 8 years ago. How did that hold up? That's coming up next. This is Bloomberg.
We have some headlines here. The Senate Republicans have released their version of the big, beautiful tax bill. And what we can tell you is that the Senate GOP tax bill would raise the U.S. debt ceiling by $5 trillion. Of course, that X date is coming soon. We understand, according to Treasury Secretary Scott Bessent, sometime in August. We'll give you more details as they become clear. Romain?
All right, let's take a quick look, Scarlett, back at this day in history, all the way back in 2017. That was when Amazon stunned investors with an almost $14 billion deal to buy Whole Foods. That announcement sent shockwaves across the industry. Shares of grocery chains like Kroger and Super Value plunged as much as 20%. Investors really pondering what a cutthroat price competitor like Amazon would mean for an already cutthroat, low-margin world of groceries. Broadline retailers like Target slid, and even real estate companies like Kimco sold off. Now, while Amazon shares initially rallied, there was concern there, too. At $13.7 billion in cash, the deal dwarfed all the acquisitions Amazon had made over the previous decade combined. That includes its 2014 purchase of video game service Twitch, which was just for a measly $970 million. In fact, the Whole Foods deal still remains Amazon's biggest ever acquisition by far, almost double what it paid for MGM back in 2021, quadruple what it paid for One Medical in 2022. However, integrating Whole Foods, that's proved way more difficult than imagined. First, there was a profitability mismatch with sales growth and returns for the grocer in decline at the time. Complicating matters was Whole Foods co-founder John Mackey, who really didn't want to sell the company, but he had been under pressure for months from activist investors who he referred to as, quote, greedy bastards who are only interested in only profiting from a forced sale. Well, that forced sale really did happen, and now it was Amazon's task to make it work. But executives at both companies ended up taking the unusual step of a hands-off approach to integration, which let Whole Foods operate independently. That was great for the chain to retain that Crunchyroll ethos that it had, but it didn't necessarily benefit fully from the economies of scale, the e-commerce chops, or the efficiencies that had made Amazon a retail behemoth. Mackey, he finally stepped aside in late 2022, and the real integration, that began then. Amazon pushing for more overlap with the parent company. And just last week, an internal memo became public that showed Whole Foods corporate employees now joining Amazon's HR programs, and Amazon's other grocery offerings like Amazon Fresh and Amazon Go, now being folded with Whole Foods into a broader food retail umbrella that should, at least by intent, make things a little less confusing for consumers and hopefully more efficient for Amazon as a whole.
All about efficiency, isn't it? All right, well, entrepreneur Bozoma St. John is known for her past roles in the C-suites of Netflix, Apple, and Uber, just to name a few. Her superpower is branding and marketing, and she recently joined The Close to discuss the power of personalized messaging, AI, and how she got her start.
I really didn't know that marketing was a career when I was in high school, and I would say even in college. You know, I was pre-med, I was very much a science type of girl. But I also loved the arts very much. But I looked at that more as a hobby and not as a profession. And I took a year between college and med school to sow my royal oats in New York City, which is where I then fell into marketing and advertising at Spike Lee's agency. I really joined his company to sort of make ends meet between college and med school, and found that advertising was an industry that I was not even aware I could be a part of. Like from a creative standpoint, pop culture, understanding the connection between commerce and all of the things in entertainment that I love was not even a thought. But Spike introduced me to that, and I was hooked.
How much has it changed? Because we talk about, Spike, of course, changed it in a big way back when he started his ad agency. But even going, you think about your tenure at Netflix and, a very algorithm-driven company and bringing something a little less algorithmic to that process. Your work at Uber, your work at Apple. The way that we try to connect, that brands, I should say, try to connect with their consumers, their potential consumers, that has evolved in a big way, and I'm sure it's going to evolve in an even bigger way in the years to come. What's been the biggest thing that you noticed, the biggest change over those years?
Well, Romaine, I would say that, from the beginning of my beginning of my career, which was 25 years ago, to today, the biggest thing that has changed in marketing is personalization. The use of tech in order to get to individual consumers and make them feel like you're talking to specifically them. At the start of my career, we're having mass marketing, right? Where you feel like at least you're trying to get to the most amount of people with one message that's going to happen on TV, or it's going to be in a magazine or in a billboard, and you're just trying to get everybody at one time. Whereas my work at Apple or at Uber or at Netflix really became about how to tailor messages to individuals. And for a while there, it was a little tenuous because, folks were not used to having personal messages and could get a little creeped out, if they felt like, oh, this company knows me. Like, why do they know me so well? Are they collecting my data? How do they know that I like this movie? Or how do they know that I like this song? And now we're in an era where if you are a brand who operates in a space of personalization, even if you're a fashion brand and you're serving up options to your customer, you have to have some level of personalization. Otherwise, people get annoyed. They're just like, well, why are they offering me this when I have no interest in that? And so from a marketer standpoint, personalization has probably been the biggest change in the market from when I started to today.
And there's been a lot of discussion now about using more artificial intelligence tools to create advertising and marketing campaigns, and some of them completely Xing out the human being in the process altogether.
Well, look, I feel like sometimes extremes are like the worst thing, I feel like the best use of technology is when there are human beings powering it and putting the info in to then get the result they want, right? In my perspective, it's like, look, you're only going to get the best AI if you have great questions that are going into the system to then get you the information that you need or the campaign you want. I don't think it's ever a solution to be completely devoid of all human creativity. There's just way too much that we understand from an emotional standpoint, and that's what marketing is. At the end of the day, it is an emotional connection that you're making between a product and its audience.
I am curious about the idea of building a personal brand. And of course, you yourself have certainly done that very successfully. So for somebody new, somebody young, I should say, coming out and trying to sort of establish themselves, not just necessarily in the marketing space, but really any industry, how effectively can you do that in this day and age?
Oh, well, I think very effectively. Today, we have so many tools at our disposal to help create personal brand. And I know for a little while it seemed like a dirty word to say because maybe you're too self-involved or you're arrogant thinking that, well, I can build a brand around myself and sell it to people. But I really look at it as simply your reputation. We've just engineered it to be a little more fluid and to have more strategy around it.
Bozoma St. John there, the former CEO of Netflix and former brand officer at Uber, and Shazia Mo. And of course, she's got a big show coming out this fall with Jimmy Fallon. We'll be back in a second. This is The Close on Bloomberg. All right, here's what the market's going to have their eye on over the next 24 hours. We start in Japan with their latest rate decision.
And they're expected to keep the rates unchanged, but they may consider slowing down their bond purchases.
And back here in the United States, 8:30 a.m. Eastern time, a look at retail sales. And we get some other economic data points as well.
Yeah, the National Association Home Builders, so housing prices coming out at 10 a.m.
At 10 a.m. there, and you can see the retail sales figure here. Some huge distortions, of course, we've seen in that data as of late. And then, of course, day 2 of the G7 summit. Be interesting to see if there's any agreement on anything, particularly with involving the United States.
We already know they're not going to even try for a communique, so maybe there will be some headlines or progress on trade deals.
Yeah, possibly. Maybe some of the bilateral talks can bear fruit. Balance of Power team, of course, will be all over that. They come up at the top of the hour, right here on Bloomberg.